Hello everyone. Welcome to the Stock Minds web channel. EQT Corporation, NYSE, EQT, has delivered a striking set of results in its third quarter of 2025, positioning itself as one of the most compelling growth-attractive names in the energy sector. With revenue and earnings surging year over year, healthy margins, improving cash flow, and favorable analyst sentiment, EQT may well be undervalued relative to its strong fundamentals. In this video, we will dive into EQT recent earnings, stock performance and valuation, growth potential, and the risks investors should consider. About EQT Corporation. EQT Corporation is a U.S.-based energy company focused largely on natural gas production and related infrastructure. Headquartered in Pittsburgh, Pennsylvania, the company has roots going back over a century, having been founded in 1888. EQT is known as one of the largest natural gas producers in the Appalachian Basin, including assets in the Marcellus Formation, and operates assets across natural gas exploration, development, and related infrastructure. Its business model combines upstream production with operational efficiency and capital discipline. Over the years, it has continued to expand its asset base and pursue cost efficiencies. EQT Financial Performance. EQT Corporation delivered an impressive financial performance in the third quarter of 2025, showcasing substantial growth across all key metrics compared to the same period last year. The company reported revenue of $1.78 billion for Q3 2025, a 51.41% increase from $1.17 billion in Q3 2024. Earnings also improved significantly, with EPS rising to 53 cents in Q3 2025 from a loss of -54 in Q3 2024, marking a strong 198.15% year-over-year increase. On a trailing 12-month TTM basis, revenue reached $7.7 billion, up 66.75% from $4.62 billion in the prior year, while EPS surged to $2.91, an impressive 334.04% jump from 67 cents in the same period last year. Additionally, free cash flow per share, TTM, climbed to $4.06, representing a 283.02% increase from $1.06 a year ago. EQT maintains strong profitability with a gross profit margin of 77.5%, a net profit margin of 23.1%, and a free cash flow margin of 32.29%, reflecting the company's operational efficiency and disciplined cost management. Furthermore, EQT demonstrated sound financial health with a return on assets of 4.09%, return on equity of 8.49%, and a conservative debt-to-equity ratio of 0.31. Over the past 5 years, EQT has grown its revenue by 25.6% and free cash flow by 40.5%, while its net income has turned positive after being negative 5 years ago. Although EQT's financial performance tends to fluctuate with energy prices, the company has grown rapidly this year and is projected to continue expanding in the coming years. EQT Fiscal 2025 Financial Forecast. Looking ahead, analysts project continued momentum, forecasting 2025 revenue growth of $8.43 billion, a 59.87% over 2024's $5.27 billion, and non-GAAP EPS of $2.85, up 77.09% from $1.61 in 2024. Wall Street analysts give a buy rating, with a consensus price target of $63.41, implying an 18.08% potential upside, and the most optimistic target reaching $80, suggesting nearly 48.97% upside potential from current levels. EQT stock price performance and valuation. At the time this video was created, EQT stock was trading at $53.70 per share, marking a 45.2% increase over the past year, well ahead of the S&P 500's 16.9% gain during the same period. Over the last 5 years, EQT has generated an impressive 232.5% total return, more than doubling the S&P 500's 95.8% rise, underscoring the company's consistent performance and investor confidence in its growth trajectory. Despite these strong gains, the stock remains attractively valued relative to its fundamentals. EQT offers a 1.17% dividend yield, providing investors additional return. From a valuation standpoint, the company trades at a price-to-sales PS ratio of 4.21 on a trailing 12-month basis and a forward PS of 3.98. The non-GAAP price-to-earnings PE ratio stands at 18.91 TTM, with a forward PE of 18.83, both levels that suggest the stock is fairly priced given its strong earnings momentum. Additionally, the price-to-free cash flow PFCF ratio of 13.46 highlights a low valuation. Based on Fiscal.ai data, the valuation since 2022 shows that the forward PS ratio is above the average, while the forward PE and PFCF ratios are below the average. This indicates a potential undervaluation as EQT's business is still projected to grow rapidly. EQT growth potential. EQT growth prospect remains strong, driven by several factors. 1. Accelerating demand from data centers and power generation. EQT Corporation is uniquely positioned to capitalize on explosive growth in natural gas demand driven by artificial intelligence data centers and power generation facilities across the Appalachian region. The company secured long-term supply agreements for the 665,000 MMBTU per day Homer City Energy Campus and the Shippingport Power Station conversion, representing approximately 1.5 billion cubic feet per day of new demand expected online between 2027 to 2028. With roughly 55 gigawatts of announced data center capacity in EQT's operating footprint, analysts project AI-related natural gas demand could reach 11 billion cubic feet per day by 2030. These strategic contracts provide visible investment-grade revenue streams with 20-year terms, effectively locking in substantial future cash flows while positioning EQT to capture incremental volumes as regional electricity demand grows 4 to 5% annually, well above historical norms. 2. Strategic LNG export market expansion. EQT has systematically expanded its liquefied natural gas exposure through a series of high-value long-term offtake agreements totaling 6.5 million tons per annum with major export facilities including Sempra, NextDecade, Commonwealth LNG, and JERA. These 20-year contracts, priced on a Henry Hub index basis, provide EQT with direct access to international gas markets where prices average $13 per MMBTU compared to domestic Henry Hub prices near $3 per MMBTU. This strategic positioning allows EQT to capture approximately 15% international price exposure while benefiting from U.S. LNG export capacity expansions expected to nearly double this decade, reaching 27 billion cubic feet per day by 2037. The LNG strategy delivers patient capital allocation with minimal upfront investment while securing premium-priced offtake for future production, fundamentally diversifying EQT's revenue base beyond volatile domestic spot markets and creating sustainable cash flow growth independent of regional basis differentials. 3. Olympus Energy integration delivering immediate synergies. The $1.8 billion Olympus Energy acquisition closed July 1, 2025, represents a transformative growth catalyst, generating approximately $530 million in annual adjusted EBITDA at an attractive 3.4 times multiple and 15% unlevered free cash flow yield. EQT achieved operational integration in just 34 days, the fastest in company history, immediately capturing operational efficiencies, including drilling 2 deep Utica wells 30% faster than Olympus. Historical performance, saving over $2 million per well. The acquisition added 500 million cubic feet per day of net production and raised EQT's 2025 sales volume guidance by 100 billion cubic feet while maintaining capital spending discipline. With over 10 years of high-quality Marcellus inventory and 7 additional years of Utica potential on 90,000 net contiguous acres adjacent to EQT's core position, the integrated asset base strengthens EQT's cost leadership and extends its development runway substantially. Risks to consider. While EQT looks like an attractive opportunity, we should be mindful of potential risks. 1. Market supply and demand risks. EQT expects a potential LNG oversupply in the U.S. between 2027 and 2029, which may cause short-term price and volume declines. This risk arises partly from new pipeline projects, including Permian Basin expansions, adding to supply capacity and impacting market dynamics. EQT has timed its LNG contracts to align with these conditions, anticipating supply to tighten after 2029 as global demand and prices recover. 2. Regulatory risks. EQT Corporation operates under stringent environmental and safety regulations, particularly regarding methane emissions and hydraulic fracturing. These rules can raise operational costs, potentially delay projects, and restrict production capacity. Despite achieving net zero Scope 1 and 2 greenhouse gas emissions ahead of 2025, EQT must continue adapting to evolving regulatory demands, which may affect project timelines and expenses, requiring ongoing investment in emissions control and compliance measures. This regulatory environment poses financial and operational challenges. 3. Operational risks. EQT's operations face significant hazards, including drilling accidents, equipment malfunctions, and natural disasters, all of which can trigger production stoppages, cause property damage, and lead to environmental liabilities. These risks require rigorous safety and maintenance protocols. Aging infrastructure further exacerbates the risk of failures, increasing downtime and operational costs, while strict environmental and safety oversight adds complexity to managing these hazards effectively, posing financial and operational challenges to the company. Conclusion: EQT Corporation stands out as a strong growth and value opportunity in the energy sector. The company's Q3 2025 results demonstrate exceptional revenue, earnings, and free cash flow growth, supported by healthy margins and solid balance sheet strength. With continued analyst optimism, reasonable valuation ratios, and a history of outperforming the broader market, EQT remains well-positioned for long-term upside. Despite potential risks, its strong fundamentals and growth potential make EQT an attractive stock for investors seeking sustained performance. What do you think about EQT? Are you buying, holding, or passing? Drop your thoughts in the comments below. If you found this video helpful, please make sure to like, subscribe, and hit the bell so you don't miss my next stock analysis. Thanks for watching, and see you in the next one.